Okay, so I'm going to call names. Ace, would you like to unmute your mic and tell us how it has been for you, learning on finances, your expectations for today's session? Yeah, so.
Hello. Yeah, good
Your network is breaking.
Hello.
Hello, we can hear you
This
now.
thing.
We can hear
Okay,
you
is it
now.
better?
Yes,
Okay.
it is.
Yes. So yeah, I'm excited to be here. It's been awesome getting to read about the richest man in Babylon. I mean, last Saturday was pretty much amazing. I've been going through the 10 series course by Chai Finance, and it has been really, really good, right? There was the part, I think the first part of the course, where he was talking about increasing your earnings, right? And he also mentioned, and I think it made a lot of sense to me. Um, right now, for most of us, our earnings is our salary, right? But even with our jobs come some non monetary or like some benefits that are not cash that could definitely improve our abilities to earn more. You understand? Like for instance, my company offers courses, right, that you could take that enable you improve your worth and then increase your capacity to earn more. And uh, getting to read about that, this is the thought just struck. Oh, I could take advantage of this and then get to also increase my earnings too. So it has been really awesome. So today I'm excited. I mean, it's our very own books. So I'm excited. I know the books of wealth and finance are going to be even more open today, and I'm excited for it. Yeah, thank you so much.
Thank you so much, Ace. That was spot on. I'm also excited. Thanks so much. I'm also excited about this session. I'm really excited too, and I really look forward to it. I've been looking forward to this session, and it feels like a dream come true. So yeah, I'm sure that most of us we know who Bukunmi is, and then but for protocol's sake, so I'd like to introduce who Bukunmi is to us. Oluwabukunmi is a portfolio management analyst at Cardinal Stone Asset Management, one of the Nigeria's fastest growing asset management firms, where she handles private wealth management. Prior to this, she worked as a data business analyst in a consulting firm where she facilitated the growth of an edtech startup. She's passionate about using technology to drive health and education solutions in Africa. She has a bachelor's degree in pharmacy from Familoye University, Ife. She's the founder of Bookhub Africa, a community of over 100 well-informed leaders across the world. So I don't know if we've read this Bukunmi's article from RX to FX, from pharmacy to invest to finance. And to me, I go back to the article every time that I'm confused about maybe a path in life, and it just feels like the transitioning feels like a very big one, from being a pharmacist to being a portfolio manager in one of the um, investment companies in Nigeria. So I really look forward to this session, and I'm sure that you all are also looking forward to this session. So if you have questions, please kindly drop them in the chat box. I'll read them out. If you would also like to raise your hand to ask your question, you can also unmute when it's time for Q&A. So the Q&A session is later into this session, like after Bukunmi session. So please, guys, kindly pay up attention and get all your learnings, get everything that you need to get from this session, because it is a value-packed one. Thank you so much, Bukunmi, for taking this up. Thank you so much. Over to you.
Okay, good afternoon. Can everybody hear me?
Yes, we can.
Okay, yeah, good afternoon, everybody. I'm so happy to be here. I'm kind of nervous too, because I had a very long week, and like it was really hard trying to put this together. Ori has been dragging me since forever to actually handle a session. And I'm glad I'm able to like finally do this. So just to put this out there, this is going to be a series because when you talk about investment management and understanding all of that, even people in finance, not everybody in finance even understands everything because it could be a lot sometimes. So I will try to stay on topics or on relevant topics, considering the fact that we are all not finance trained. I would try to not go too detailed into the nitty-gritty of understanding all of the whole calculations and all of that. So the idea is to help us like really understand. So that's putting it out there. I actually tried to work on a slide, but I could not, sorry, or I could not like put that together. I just started trying to put everything together in a slide, but I wasn't able to complete it before now. However, like I said, it's a series, and we hope to do this again next week and subsequent week, depending on the feedback that we get yes from this session. And like I said, this was actually created or curated based on the feedback we got from the community. Yes, so I would share a very funny slide. Please don't. I was trying to like put them together, but like I said, I'm not done. So the slide is not very complete, but just to help us like through the line of thoughts. Please let me know when you cannot hear me. So I know I'm not speaking to myself. So I'm also honored to be here. Okay, yes, I don't know, I'm just somewhat, what's the word now? I'm somewhat, I'm nervous for some funny reasons. Yeah, and I know why I'm nervous. I just feel like I'm not adequately prepared, but I think we can do this. Okay, so yeah. This is my funny slide. Let me know if you can see it.
Yes, we can.
Okay. Yeah, so we're talking about I think like Ayi said earlier, this is our money or say our finance month in Bookhub. We've read Richest Man in Babylon. I've read the book before, but it's actually good to really go back. It's one of the foundations of understanding finance and all of that. Yeah, so and also last week we had a session with the founder of Tri Financials on 3Ms of money. So this week I'm going to be going into more details on what's like different kinds of investments, and like of course this one is equities investment. But before we actually go into like the real, let's start from the basics. Like, okay, we need to understand that there is a financial system, right? And just like, coming from the health background, we say that there is health system, right? There's education system. So there's a system of like, say, finance, and it actually includes a lot of financial intermediaries that help transfer financial assets and risk from one entity to another, one place to another, and one point in time to another. Okay, let me just explain that. So it's more like it's like a system. It consists of many parts. So there are many parts in the financial system, right? Many moving parts. So we have the borrowers, we have the lenders. In my head, what I actually would have loved to do was to actually draw a sketch of how the moving parts are. But I think I'll work on the slides, promise, and next week I'll probably share it. It's more like money flows from the borrowers, no, from the lenders to the borrowers, right? And within this flow of money from the borrowers from the lenders to the borrowers, there are a lot of things that happen, right? So in the system, we have the borrowers, we have the lenders, we have the brokers, the dealers, and would probably talk about that maybe in subsequent sessions. We have people who help you manage your money. Like there's just a lot of parts going on where, and money doesn't mean money like cash. It could also mean, can you hear me?
Oh yeah, sorry. Yes, I can. I wanted to meet someone.
Okay, I think my slides went off.
Okay, so
And
I'm
you've
getting it now.
disabled participant sharing. Okay, anyway, so we have different players in this financial system. So we need to understand that. So also let's understand that what do you do when you save actually? I like this, I like the mindset of like understanding what you are doing when you save, right? So saving is just a form of moving money that you have from the present to the future. So you have like an inflow of money. Saving helps you move that cash flow that you're having. Okay, so you work as a say a product manager in a
Oluwabukunmi, I
place.
fix that, so you can.
Okay,
Sorry.
okay. So yeah, so I'm on the second slide now. Saving moves your current earnings into the future. Like you have, I was saying that you work as a product manager, so you earn a particular amount of money. I want you to understand. So because if you don't understand what you are doing, you just, everybody just saying save, save, save. But if you don't understand, like say the psychology or like what you're exactly doing when you save, you will just keep making like funny decisions when it comes to saving, investment, and say whatever that comes with it. So saving helps you move your current, like I said, money from the present to the future. Why borrowing? For borrowers, they move like future money, like borrowing helps you spend money that you don't have and repay with money that you earn later. And that goes without saying. When you borrow from people, when you borrow, like say on a personal level, you don't have this current money, so you collect money from somebody who at that moment has like excess money, quote and unquote, or has money that he's not using. So if you actually look at it, ideally the money you earn every month, there should be enough to keep away, or you should be able to keep some money aside. And there are different reasons why you keep money aside. I remember a friend back then in uni used to say that he doesn't believe in savings because he believes that God will supply all his need at every particular time. See, fair enough, everything, it works differently for different people. Some people believe that they would continue to earn, so they just spend all they have, and that's fine, right? Hopefully life does not happen and like they will probably just keep on like that. But sometimes you actually keep money up aside for different reasons. One, because of the unpredictability of the future, right? Nobody can predict what's going to happen in the future. So that's why you put some money aside. And we're not praying for bad things to happen, but emergencies happen. And I think we already treated that last week, that you save towards emergencies. Also, sometimes you might have like an opportunity to do something, like say buy a land. But if you don't have any money set aside at that moment and you're relying on your earnings every month, or say we are relying on your business, whatever, you probably will not be able to make that decision at that time because you don't have any money saved. Do you get? So I think I encourage saving, of course, it goes without saying, but well, when I have conversations with people that don't think that they should save, well, I hands off, because everybody has their own, like if you read Psychology of Money, which you did in January, nobody is, well, don't let me say, somebody says I should not say nobody is right or wrong. Everybody is right. So far you do what makes you happy, right? But essentially, borrowing helps you to spend the money that you do not have and repay with money that you earn later. So now, what is investment? Investment compensates for the risk of losing money and also for the use of your money alongside inflation. So now, let's go to investment. So investment, so now I spoke about savings, but what happens when investment comes in? Investment compensates for the risk of losing money. So now, money, I told you earlier that there are different things that happens in the financial system, right? So money moves from the lender or the saver to the borrower. So now, if I'm giving you money to do something, or to so now, okay, I said, okay, no, I don't want to save my money, I want to give it out. So I don't want to keep my money just lying down without it doing anything. right? And I know sometimes when we're younger, we did this box colo, where you put your money aside. So instead of putting your money aside like that, without it doing anything, why can't I move the money to somebody who needs it? That's our borrower. Please let me know if you're following. I would, if you need me to go back, if you need me to like re-explain. So instead of me to put my money inside the colo, why can't I just give somebody who needs it, who is the borrower, that needs it to do, like, say, a business, or say something like hello, okay, like a borrower can also be the government, right? Why will I leave my money inside the colo? Why can't I just give somebody who needs the money, right? And let that person use that money to do a particular thing, to venture into a particular, to do, say, like build roads, for example, in the case of government, or pay salaries, or whatever. And based on the promise that that person is going to give me in a later future, right? I hope we understand what I'm trying to explain. If you don't, somebody is writing something in the box. Oh, okay. What if you borrow to save? Okay, you cancel. Okay, yeah. So now this is what we're going to talk about now. So investment, like when you are giving a borrower, when you are giving money to a borrower, when the saver is giving money to a borrower, the borrower, who is let's say a company in this instance, because you're talking about equities investment, but we're going to get there. The borrower would pay you we'll call it, now this is where the interest rate comes in. We'll pay you some particular amount of money depending on the kind of structure of the finance anyway. So the borrower is paying you a compensation for the risk of losing money, because if you give a borrower money, you're not sure that the borrower is not going to go and take your money and go and use it to save, like like Olisa said now, or the borrower will go and use your money to go and do Baba Ijebu, or do something that is going to probably venture into a business that would probably lose all your money. So because there's a risk, which I actually also might touch on, there's a risk with giving somebody your money. Like, I am not sure that you're going to give me my money back. So instead of just giving you the exact money that the person is borrowing, the person is now going to pay extra, number one, for the risk that I'm giving you money, and also for the risk of losing money, because you have to pay for the risk. Then also for the use of your money. Like, I'm giving you money to use, you don't have money, so I'm giving you money, I am the chief here, so you're going to pay extra. So you're not going to collect just your cash back, you're collecting extra. That's a premium sometimes. So now I just saying in an ideal situation anyway. And alongside inflation, so we're saying that maybe the worth of the money that I like, say I'm paying you, I'm borrowing you, the saver is giving the investor, or no, the saver is giving the borrower. So now saver, investor, lender, they are the same thing. So the saver is giving the investor some amount of money, right? And we're saying that money that I'm giving you now might not worth the same money next, might not be able to buy the same value, or might not, yeah, I'm trying to explain inflation here, like that the money would have reduced or become, but the value of the money would have reduced along this particular time t, over this particular time t rather. So you have to pay me pay me more for that. Like, I don't know if you guys understand that, that's my like the flow of thoughts anyway. So now, also, borrowers believe, so that's the risk, that's interest rates. That's why you say, what's the interest on this investment? What is the interest? So you're collecting money, but you're also collecting interest, because you have to pay for, like, the reasons that I gave above. So also, borrowers borrow because they believe that they will have cash flow in the future to pay the lender. Ideally, that's for sensible borrowers. You borrow money because you believe that sometime in the future, this deal will click and I'm going to pay you back. So I think that's me just trying to explain, like, the whole concepts there. And I don't want to go into, like, details there, but, like, that's basically what it is. So let's go to the next slide. Like I said, please don't mind my slide. So now, companies, let's think about companies like Dangote, like any kind of company, Bill Gates company, what are the companies we have? Any kind of company. So company, when you want to raise, like for, okay, so I have an idea. I want to say, let's say I want to start a farming plantation or whatever. Please, who is there? Who is talking? Okay.
Mufasa, some trends.
Okay. So let's say I have an idea and I want to start a company. So there are two ways by which, so my own money in its own self might not be able to fund my idea. So that's why companies raise money. Companies raise money to fund their ideas, basically to execute, to scale, to build something. Because like in the real sense of it, I see when people say, Dangote is borrowing, is this, is that. Like, of course,
Hi,
oh,
Mufasa, please, can you mute your mic?
I think I can mute. Okay, I've muted them. Okay. Yeah, so please, anyone following, am I making sense? Let somebody unmute, and I'm still going to interact, but I'm just trying to explain something. But if I'm making sense, let somebody unmute and say something if you're getting something from all of this.
Yeah.
Yes, you are.
Okay, so yeah, so now companies raise money either via debt or equity. So now debt and equity, there are different ways by which the borrower, I explained the borrower and the saver. So there are different ways by which the borrower collects money from the saver, right? So debt is mostly what we call loans, the normal loans that you talk about, like say somebody, your friend comes to you and say, mostly when it comes to friendship, you don't want to collect interest. You just want to be a good friend anyway. But in ideally, right? That's what banks give you. Let's talk about the notorious loan givers. Like ideally, so you have this idea, you need money to scale. That's as a company. You in this case is a company. So so you go to the bank and ask for a loan. So they give you a particular, they give you, the bank in this case is a saver, because the bank, okay, no, I don't want to confuse. But when you save money with the bank, right? When you keep your money in the bank as a deposit, right? You don't expect the bank to the bank in this case is your colo. You don't expect the bank to just use your money, just leave your money there and looking at the money, right? So what happens in that case? Borrowers, remember our borrowers, they need money that they don't have now for the future, for future earnings, for projects. They go to the bank and say, please borrow me money, we need money for something. So those are companies in this case. So banks give them money at a particular interest. Remember I talked about interest. They give them money. And remember that when you're collecting money from somebody, like I said in this place, you pay the risk for losing money. So when the bank is giving you the interest or the interest on the loan, you know why people say that banks give high interest rates? No, don't go and borrow money from the bank, because they believe that they are taking a risk on your company. Your company is probably Mrs. Oluwabukunmi and Sons Limited company that does not have any track record, that does not have any prior experience in establishing anything. So the bank believes that giving you money is very costly to them. So what would they do? They will charge you higher rates, because there's a possibility that you will not give them back their money. There's a possibility that they're going to run away with their money. So ideally, that's why you see some people charging higher rates on companies, right? And yeah, alongside the use of your money. So the banks might think that, I'm not really sure about this, your idea, but I think just depending on what so for a Dangote, for example, I'm going back to interest rates. For a Dangote has proof of work. Dangote has concept. Dangote has built Dangote refinery. So you can get money at lower rates from the bank, because even the bank will be glad to actually borrow Dangote money, because they're like, this one is sure. So the risk for borrowing money for Dangote will be lower than the risk for borrowing money for Mrs. Oluwabukunmi and Sons kind of company, right? So that is debt. That's debt. Debt, you borrow money, you borrow a particular $10 million or 10 million naira, and you pay 10%. every month. If you do it simple interest when you're in school, you're talking about debts. I collect this money, 10,000. I pay this monthly, yearly, depending on your conversation with the saver or the lender. So you pay a particular amount of money with interest. So in all of that I said, there are different things you can unfold because there are different finance. But like I said, we're not going to bog ourselves down with different finance details of finance. But with equities now, which is what we're going to be talking about, which is another way that companies actually raise money. Now, what happens when companies raise money with equities? And it's very funny because some people just say, okay, you want to invest now. I've learned about finance. I've learned about investing. I want to invest. Let me just go and buy money in the stock and buy MTN stock, buy Microsoft stock, buy this stock without understanding what exactly you are doing. So with equities, right, you are buying. So the company is saying that we have an idea. We have like this massive project we are trying to embark on, but we want to raise money. So they are giving you a share in the company when you buy equities, whether you buy it on the stock or you buy it anyway. You're like a part owner of the company, right? They are giving you like, so whether if you hold like MTN stock, you are a shareholder in MTN right now. If you hold Microsoft stock, you are a shareholder. That's a way of raising money. That's another way of raising money. But the other side of stock investing, of equity investing, is that there is no fixed amount that you get back in your stock investing. How do I mean? I explained debt that you collect a particular amount based on the risk, based on like say 60% every month, and you are contractually obliged to actually pay back. Like that's for debt, that's for loans. And if maybe you have experience in loan sharks and everything, if you don't pay, your interest is continue to mount up. So for the borrower, it could be expensive depending on how you see it. But for equities investments like that, it's not as expensive. Well, now I would explain that, but like it's not as say burdening as say a debt financing, for example. So with equities investments, once a company releases, like if they want to really get money from people, they're like, pay me this money and come and own a share. Instead of them giving you a fixed amount of money, they just give you a share in the company, and they are not obliged to pay you any shishi kobo for the money you give them. So what are you? You are just a shareholder. You're a part owner of the company. So you can take it to anywhere and say, I own Microsoft. I bought like $10 of their shares. So whether it's $10 or $20, you're a shareholder, right? So that's what equities investment actually is. So like I said, is ownership rights in the company, and it could be common equity or preferred equity. And I'm not going to even start to explain what the difference between common equity or preferred equity, but let me just say that if you buy on a stock exchange or like through an app like say RiceVest, Bamboo, all of those things, you're actually buying mostly common shares, right? And with common shares, you have the right to actually votes, although I don't think anybody votes, because I don't even think you attend the annual general meeting of the companies that you bought the shares in, because most times what we do when we buy shares, we just buy shares, just say, this share is going up, you just go and buy it, and you don't even read the research reports of the shares or anything. You just like buy the shares and maybe never even look back, right? But now this is where I'm going to like maybe dwell a lot more in. Right. So wait, let me see how I'm going to say it. Okay, yeah. So now there's primary market and there's secondary market. If I'm talking too deep, if I'm putting too many things outside, please just kindly nudge me. I don't want to go too deep into finance. I just want the things that you need to understand, right? So in primary markets, right? Primary markets, before your stock, I believe everybody knows Bamboo. If you know, like, okay, how many of us own shares in a company? Let's just signify by dropping yes in the comment section, so I know the kind of if you own shares, whether it's even 10 units worth of shares of Microsoft, can you drop something in the comments? Just drop yes or I, or just a smiley. I want to know if I am talking to people that just drop something you own, even if it is 2 kobo. Yeah. Olisa, please, I beg. I beg. Shares in a company. I not say Bitcoin. I'm talking about companies. You own shares in a company. Okay, so yes, price stock. Yes, I used to withdraw stock when stocks were around for my life. Okay, so now that brings me to the second question. If you own a stock in a company, how did you get that stock? How did you buy the stock in a company? You can just write the apps that you use: RiseVest, Bamboo. What are the other ones again? Trove, Trove, RiseVest. Okay, so now basically Chaka, okay, yes, exactly. So there are different ways that you can actually acquire shares, right? So now, thank you for responding. So there's the primary market and the secondary market. So what you have done now is to actually acquire the shares in the secondary market. But I don't know if you guys know IPOs. What happens? That's initial public offerings, right? Okay, so let me start like this. I hope I'm not confusing anybody, because that's why I was nervous, because I don't want to get everybody off board. So when a company, I started by saying companies can either do debt or equity, right? They can raise money through debt or equity. So I have an idea, and I will just try to incorporate some of startups. Like, okay, say a startup, I have an idea for a startup. What I want to do for startups, most startups like to go to equities because debt is more costly. Because if you are a startup, you just have an idea, you go and collect debt, you collect loans, you don't even, your idea itself, you don't have customer yet, you go and collect loan. Immediately you collect your loan, the day you collect the loan, it starts to count. And loan people, they don't want to hear anything. By month 6 or month 12, depending on the structure of your loan, you have to start paying your interest back. And as a startup that does not have a customer already, you don't want to collect loans except you run a credit business. You want to probably, so that's why most startups, you hear venture capital, you hear private equity. So that is why most startups run to venture capital, because you can collect money without paying. When you collect money from, say, a venture capitalist or like angel investors, they give you money. That is like you give your friend money, but you are not, the friend is not obliged to pay any money back, at least for the beginning of the business, right? They keep the money. All you have is that you have shares in the company. It is written in the term sheet of the company that, oh, Oluwabukunmi has 2%, 3% of this company, right? So that is like at the beginning of the business. Most businesses, especially at the beginning, they prefer rather equities investment, and that is a form of equity investment. And in primary markets, like issues like security, like the issuer, rather, this is supposed to be issuer, sell securities to securities in the securities, like the shares I'm selling to investors, directly to investors. Me, I am the company, I sell it directly to investors, right? There's something they call private placement. So even big companies can sell shares directly to investors, and investors are not like us. So they are deep pocket investors, people that have, like, if I'm going to raise like a 2 billion naira, I want to raise 2 billion naira in the market, and I just go to people that I know can drop. Some people will drop 50 million, some people will drop. So private investment, private placements, you give them and they collect shares. There's no too much. They're not coming to come and meet you in the public market. So we are the public, sort of ish, right? That's the way to explain it, right? So even in an initial public offering, which I think MTN did last year, and also okay, I was talking about a startup that raised money, equities. So if you hear Series A, Series B, Series C, Series 1, Series whatever. So those are like they are raising money in the private markets, right? In the venture capital is a form of equity investment. That's what I'm just trying to say in all essence. that is not open to the public. This is just select people. Sometimes, like you have, like, especially if you're angel investors, you have $1 million, you want to invest. I will just pick a company that I think is very nice, that has good prospects. I invest in the company, they give me shares in the company, and like at each round, I get diluted, but my stake is still there. I'm not going to go deep into that. Eventually, the company, there's proof of work, the company has expanded, like they have, like, big stuff. Now they want to go to the public. That's what I say, initial public offering. That's IPO. That's the meaning of IPO. Now they are going into the public to source for money from everybody, right? They've gone beyond angel investors, VCs, and all of that. Now they're going into the markets. That's what we call the secondary market. That is where you got your own Microsoft. You guys are not initial investors in Microsoft. They came into, like, they came to the public. So you bought it from, okay, IPO self, they are not even, that one is even, IPO sometimes could be primary market anyway. But now, so on the, like, for the initial guys that actually invested in the company, they can now choose at an IPO to maybe sell to another investor, like on the secondary market. So secondary market is what, say for example, Bamboo, Chaka, Chaka or Shaka, I don't know, Trove. Now, you are not buying directly from the company. You guys are now trading amongst each other on the secondary market. Like now, I have maybe say I invested, I have like 20,000 units of Microsoft, and I actually want to sell off some of my shares, right? I could sell it off on a secondary exchange or at the secondary market. That's what you are doing. You are not buying directly from, especially, so there's something called reissuing of shares that the company does directly. But largely, what you are doing, you are actually buying from another investor, right? I don't know if anybody understands what I'm saying. In the secondary market, which is what you do on let's say Bamboo. I don't want to pick. Let me just say Bamboo. You are buying from somebody that owns the shares already. So what happens on the secondary market, right? So there are a lot of activities that happens on the secondary market, and as investment manager or as someone who is an investor, you don't really have to do CFA all of that to understand what's happening on the secondary market. So sometimes when you want to choose a stock to invest in, the first thing I would advise, this is me now going into, is to actually research on the company that you're actually investing in. And research does not mean that you should run a financial model to estimate the price of the company, but it could mean you reading like just research papers on this company. So for example, the decision of Facebook to evolve into Meta, you need to understand the impact of that decision on your shares, right? For example, like if you believe in Meta, if you believe in the Meta universe, you need to well, not if you believe, so Mark Zuckerberg says, I want to evolve from just being a social platform to what's that in metaverse, all those things like that, right? So as an investor, whether passive or active, you need to just understand the impact of that. The decision of moving from Facebook to Meta actually costs Mark Zuckerberg, because some investors will be like, I don't believe in Meta. What the fuck is Meta? I don't want Meta. And that's why they will not sell. They'll be like, oh, this Facebook is running into shit. Facebook can never be successful again or something. And what happens? The activities that happen in the secondary market, some investors are selling, while some they are buying. Right, and that's why you hear that the price of a security is dropping. Why some? So it's a demand and supply kind of market, right? So when you buy a stock, or before you buy a stock, do research into the company. Who are the stakeholders? Because for secondary markets, the financial information, all of the things you can know about the company is public. You can always go to the NGX website. You will see everything. Like, say if they want to, like for example, when First Bank fired their management, all of those decisions, you will see it there on if you go to the NGX website, you will see. If you just play around it, right, just for you to get more knowledge, subscribe to, say, for example, cardinal stone research, right? But it doesn't have to be cardinal stone research or any kind of research article or research firm. Meristem actually publishes what they think about different companies, right? So before you make your decision to buy a stock, you need to understand the management is important, number one. The management, because it's people that actually move companies. The people is they are the most important financial guys in the company. Then two, you need to understand the structure of the business. You cannot just invest in a company that you don't even understand what the business is. If you don't understand metaverse, you have no business investing in metaverse, except you can just take a gamble and like, oh, it's exciting and it's interesting, which is fine too. Right? You need to understand what the model of the company is. What's this company doing? How do they make their money? Right? For example, Dangote Cement, how does he make his money? Of course, by selling cement. What is the impact of, like, what is cement industry saying at this time? Right? It could be that like there's inflation, so that means it's going to affect their cost of goods, like that's they will have higher cost of goods and it's going to eat into their earnings, right? For example, I hope I'm not saying too much. It's going to eat into their profits because now there's the cost of preparing cement is higher. That's what I'm trying to say, right? So that means that means that their profits might reduce in this time, right? So you need to understand all of those things sometimes that are affecting your investment, right? If you're investing in just generally, so I already said management. How do they make their money? How does the company you're investing in make their money? That's number two. What's the impact, the macroeconomic impact on this company? And it doesn't require you to be a finance person, like I said. It's just a little more attention to details, right? You can just, maybe there's just like a news of, say, what's the name of this guy? Otedola acquiring First Bank, acquiring majority stake, or say 4% of First Bank. You're like, I have stock in First Bank. What does that even mean? Right? If you don't understand it, you can just ask somebody, just an awareness, because when you invest in, take for example, I just explained private investment, that's private equity investment, which is what you do when you borrow your friend money. When you borrow your friend money, you're on your friend's tail. You want to know what the friend is doing, right? You want to know that, that this business that your friend said is starting is actually making money. Not talk of when you now invest in a public entity. Most of us just buy stocks and we just go, and you just see that the stock is just going up and just going down. You don't even understand why it's going up and it's going down. You need to understand that, like I said, it's a financial system. So what happens is that some people are betting on the stocks to go down, while some people are betting on the stocks to go up. So people are positioning based on the information that is made available to them. Like I said in the Meta example, when Facebook announced Meta, some people think that is a bad idea, bad. I don't want this, and they just sell off their stock and they run away. But while they are selling off their stock, remember, it's demand and supply. The stock is coming down, right? And you might say that this Meta looks like that's the next big thing, and I think I need to get in. So as the stock is coming down, you are watching as the stock is coming down. So what happens? You enter at a lower price, right? And now when you buy that stock at that lower price, you are betting that the stock is going to, betting that Meta is going to, and it is not the next big thing. Sorry for you. And that is why stock investment is very risky, right? It's very, very risky because your capital can be eroded. Now I'm going to risk. You can lose all your capital in a stock investment. And I know many of us have probably experienced that in a stock investment, where if you put 20,000 naira in a stock investment, you can lose all the 20,000 if the price of the stock goes to zero, right? And I think from he said, like, he saw the stock going down and he ran away, right? So, but with loans, with debt, right, your money is sure. You are getting back your money, and you're getting back what? You're getting back your interest. And that's why sometimes with loans, it's not as but you remember that in finance, it's high risk, high return. Because stock is risky, the returns can be very high. Imagine if you were in MTN, when MTN did IPO that last year, you bought MTN at 160 something naira. Imagine, and MTN traded as high as 250 naira this year. Imagine you bought at 160 something naira, and at 250 naira you sold off. Can someone calculate the percentage increase in that place, like 250 minus 160, let's just say 250 minus 160, that's 90 over 160 times 100. Who has calculator that can just help us calculate it quickly, just quick maths to do the returns that you will get if you had gotten out of 250 minus 160 over 160 times 100. Has anybody done the calculation? Can somebody do the calculation? Okay, so private equity.
56%. 56%.
So thank you very much, Opeyemi. Imagine that you got 56% on your investment already. That means if you had put 100, if you had put 100,000, can somebody do 56% return on 100,000? Just quick math, just to put in things in context.
Not 156,000 now.
Yeah, so that's
156,000.
Do you understand? And that's not even up to 1 year, because the last time when MTN did is, that's not a 1 year investment span. That's just under how many months you can actually get as much. So equities market actually gives high returns, but remember that with high returns you can also lose your investment, because guess what? MTN is trading at 200 naira now. Anybody that entered at 250 at that time, maybe you saw that, this MTN is going, and you think like me. Let me tell you my story. When it was 160, I did not buy. I was telling everybody to buy. I forgot to buy my own share. So it was going up, like it was like 200. And me, like fundamentally, everybody knows that MTN is actually a good company. Yes or no? Like if you like, because if you look at, okay, that's even true. Let's dissect MTN together, right? MTN is actually a very good company, fundamentally. And why do I say so? Out of all the 3 or 4 network that we have, or network providers we have, service providers, they are like the best, right? Because MTN is everywhere you go, kind of thing. Their management is actually very sound. If you check out what like the management is like, they are publishing. If you even check the way they publish their financial statements, they do it. Everything is like very arranged. It's a very fantastic company to actually buy. Remember in 2020, MTN made, where some people were making losses. MTN was just making money, because guess what? Everybody was at home using data, consuming data. So data consumption is one of the things that drives their revenue, right? So it drove their revenue really high, right? So you need to understand that. So COVID year was a fantastic year for MTN. And well, I can't remember if they paid. I wasn't in this place during COVID year, but they would have paid like higher dividends or something like that. So just imagine that now, even now, if you check the data, it shows that like Nigerians, not every Nigeria is like what we still have. Like our internet consumption is still about 40-something%, if I'm correct, and we still have a long way to go. So that means a company like MTN is actually very well positioned for the future, and it's unlikely that a company like MTN is going to fold, right? I've talked about their management. I said it's sound. I've talked about their business model. Like if you think about it in that regard, and now they even did what, 5G. They are the only ones. Okay, I think Airtel also have signed 5G, but now they have 5G. That means they are progressive. That means they are looking into the future. They are trying to provide 5G, and guess what? That would also increase their revenue. Are you guys with me? So I'm trying to analyze. I'm just trying to make you guys do just a very surface analysis of MTN, right? And what else again? They even did MTN Momo. That's another way that MTN is going to make money. That's POS banking, all those POS. So MTN revenue, we are projecting forward to altogether that MTN is going to actually make more money in the future. And so when they came into the market to actually raise money for whatever reason that they raise money there. So if I'm sitting down, I think about all this, I'm like, wow, this is a very good stock to buy. Then I buy MTN, right? But guess what? At that time, I didn't buy when they were doing their initial, the offerings that they did last year. I don't know, for whatever reason. So it was increasing, because later on, some people started to, some people cut in later, and so speculators or investors were like, this company is actually good, and I was one of them. Maybe I came in around 210 or something. I think it was already 210. I remember telling my friends, MTN is already 200 though. It's already 205. Me, I was just looking. It's already. You're still looking. You're still trying to speculate. I'm still trying to think about the time to enter. Finally, I entered at maybe 210 or 220. And he actually went to 250 at some point, and I was in the green, right? But guess what? It started to come down again. And now, if you check my portfolio, I'm in the red, in deep red. However, now this is where it comes in. Fundamentally, I am still very certain of MTN as a company, right? And that's why you need to understand your if you are doing a short-term investment, if you need, like, and I think the Tribe guy actually explained that if you're doing a short-term investment, maybe stock market is not the market that you want to go and be. If you can't put your house rent in a stock market, right? Because now that I'm in the red, is basic. I have to sell my MB at a loss. I don't even know why I bought Nigerian Breweries. I'm not really sure of that company. I would have just even rather bought Guinness, right? But like I bought Nigerian Breweries at a premium. Like it was just trading high. So I was chopping it, and I went to buy it, right? It's not like I really believe in the company. That's why I'm saying that we actually do things sometimes. Like I just bought it, like, right? And now it's now in the red. And I sold it off because I don't even believe in it. Like the company is good, it's solid, but I would rather buy a Guinness than a Nigerian Breweries, right? So now, what was I saying? Yeah, so now MTN is in the red, but guess who is not going to sell? Me, because I actually like thinking about some of the decisions they've made, thinking about the fact that the stock is actually fundamentally sound. And this is me speaking to AEs. You need to understand, like, when you're investing in the stock market, you're not investing, it's not except you're a trader. Some people do rush in and rush out kind of thing. But if you're investing so maybe I should have said it earlier, like, of course, I think we've discussed it. You need to understand why you're investing and how long you can put your money in there, right? So I am not investing for, say, a 1 year outlook. I am probably investing for a 2-year outlook, right? So I'm not going to sell out of MTN. Instead, I'm going to buy more now that is actually, of course, quote and unquote, trading at a discount, because now the price is lower. I can buy it at 199 compared to the 210 that I bought it at that time. I don't know if anybody understands what I'm saying. If I'm talking over your heads, please say something. Does anybody understand me?
Yeah, books.
Yes,
yeah,
I do.
yeah.
Yes, I do.
Okay, let me pause here. Please, does anyone have any question?
Yes, I do.
Okay, please.
I do. Yes. So I want to ask, when starting out investing, when starting out in life, right? Do you go long term first, or do you go for short term investment? I don't know. What should be the metrics to decide what kind of investment you should go for, especially when you're just starting out?
Okay, thank you, Ace, for the question. So now that question is actually very, so now I started from something. I explained the relationship between borrowing and saving, right? So when you save, remember, first of all, like, you're trying to transfer wealth from the present to the future, right? That's like you're trying to move your money across time. That's what happens when you save, right? So now, why are you moving your money? Why can't you just chop all your money right now? If you earn 100K, just finish your 100K, because it is sure that you're going to earn another 100K. Different reasons. It could be that, so as a young person, you're probably trying to, and if you're maybe you're not from a rich home or something, you're trying to build wealth, right? That's why you're actually, maybe that's the reason, number one. So you have to find your why. Why are you investing, right? Why are you making that decision to actually take a part of your money to keep? So I would say, maybe, okay, let me ask you, why do you want to keep your money? Is
I don't want to be a mechanical.
You want to be a baller.
I want to be a baller.
Yeah, exactly. So you're trying to keep your money because you're trying to actually you're trying to build wealth, right? So now that question is answered. And across what period of time, right? So if you're trying to build wealth, you need to understand for how long, and there are different reasons why you're going to save money. So I think last week we talked about saving money for emergencies, right? Emergency could be in different forms. That one, if you're saving money for your emergencies, you can't put it in a stock market, because what if at the time you need your money, now that maybe I saved my emergency money in MTN, and MTN, guess what, is trading 199. How do I account? Where will I put the loss, right? But because I am saving for a long, I'm doing long term. It's on a long term outlook, right? So I can leave my money there. But when I wanted an emergency fund, I put it in my mutual funds, right? Which we can talk about. We're going to talk about like subsequently, because I wanted to save money for emergency. I put it in mutual funds, and when emergency came, when it arrived, I said, please help me liquidate my money, and I collected my money. And I went to go and use it for whatever I want to use it for. I wanted to use it for, and I put my money back. Do you understand? So it depends on what you want. Like, so I will just give myself as an example. I have Rise Vest, I have Cardinal Stone mutual funds, and I have stock investments. And what again? Let's just say those three. I can't remember now. Right? So what I put in my Rise Vest has like three, because I said I wanted to make it as practical as possible. Rise Vest has like, they have the low income yield, they have the middle, and they have like the high yield. That's high risk. I can't remember how they put it. Maybe next week we'll do an analysis. And that high risk is, they put it in stock. If you check what they even write there, they'll say high risk stock. That means your money can go, right? But when it stays, it's going to give you more returns, right? And the medium risk, I think they put it in like, say, real estate in the US or something. So why am I doing Rise Vest? Rise Vest helps me to hedge against inflation, right? I'm investing in a middle income. So I'm doing the middle plan, right? And I'm also doing in dollars. So when I invest in Rise Vest, there are two things that happens. I hedge against inflation, and I am still gaining returns on my money, right? So when I invest, I think I have some in the low income, low risk, don't let me say low income, low risk too. So that one is just maybe like 10% per year, kini. But my money, I'm hedging against dollar, and my money is still coming. I'll get my principal and a little bit of interest, right? Then now let's go to mutual funds. Mutual fund is in Naira. That one, I don't even care about. If Naira is falling, it's not falling. All I know is that when I need my money, I'll shout, like for emergencies, maybe like, for example, last month, an opportunity incident happened. I used my car to go and hit somebody. So I need to like pay for hospital bills and something. I just go to my mutual fund, take it, emergency, quickly pay, and I'm not really burdened by the whole this thing of trying to fix all of that. So that's an example of an emergency. And after that, you start to build. Though I've not started building my mutual fund, I just want to start again. You start to build your mutual fund back, right? Mutual funds basically in Nigeria give like 8% on your investment, but you know that it is secure, right? You know that you're just using it for that this thing, right? So now so now we go to stock. And stock can be, you can buy Nigerian stock and you can buy American stock, right? So earlier and which is equities investment that we're talking about, earlier in the year, Nigerian equities investment was on a bullish bull. If you hear bull means to the moon. If you hear bear, it's going down. So Nigeria was on a bullish movement earlier in the year. So we're like, some people were getting, I think Airtel on a year to date is over like, was close to about like maybe close to 100% safe. So if you had bought Airtel last year in Nigeria, you are getting a 100% investment return on investment, say for example, and that 100% beats even your dollar investment, because dollar has not done 100%. Has it done? I'm not sure. I don't think it has done 100%, but that's also like another way. But guess what? It's also now from June, it started to dip, right? And your capital can be eroded, right? That means like, depending on how deep the price of the stock goes down, like it can raise your capital. But if you are investing on a long term and you believe, like I said, you believe in the company that you're investing in, you think that this company has their heads on their head or on their neck or wherever the head used to stay, then you don't leave, right? Forget the fact that the US market is actually red now. This is the time to maybe, but no, it's not the time to buy. this is not the time to buy, because in the US market, there's something that is happening, there's the dynamics that is playing in that will still continue to plunge your stock further. And if time allows, we might talk about it. But like, it's going deeper, it's going deep, it's going deeper and deeper and deep. But maybe at some point, it's going to be a time to buy stocks that you believe that are fundamentally sound. So in a stock market, really, you're actually betting on the fact that you have an information, you have like this outlook. Someone else is saying, no, it's not going to. So it's like a lot of, to me, sometimes I don't really like the stock market because I don't like uncertainties, right? Some people have the energy for uncertainties and all of that. So as this young person starting, you can actually, I already just explained, you can diversify your income like that, right? Based on like different reasons and different, like, so I've given you like practical examples. If you want me to talk more about that, you can. So Okoyemi, please, you have the floor. Your answer up.
Okay, thank you for that. Thank you for presentation so far. My question is more like, let's put it into practice now. Let's say someone has 12 million in Naira and is looking at inflation is at 24%, and treasury bill is around, is it 9% or is it double digits now? So looking at it, what would you advise the person to, where would you advise the person to put the money in? Because on the other hand, the inflation is taking the money.
Hold on a bit. All right, please, I think some people are saying they are in the waiting room. Maybe you try.
There's no waiting room.
Oh,
there's
okay.
No waiting room.
Okay, no problem. Okay, please go on, Okoyemi. Sorry. Please, can you take the question again? Okay, someone said you should take the question again.
Let's say someone has 12 million Naira now in Naira. So, and he's looking at two options of, okay, he doesn't want the money to be in the banks or just lying there without having any value for it. On the other hand, the inflation is taking the money away because averagely, if someone has 12 million and the inflation is at 24%, and if going into treasury bill or any federal government bond is at 9%, so the 9% that is on it won't take care. Looking at 9% and the 24% inflation, the gap is there. Like at the end of the treasury bill, he will still be losing money even though he has interest. He got interest from the treasury bill. So what are the best way to move this money into, like, okay, hedge it against inflation and also earn from it?
Yeah. So I get what you're saying. So now this is like another very interesting topic, that's inflation. Unfortunately, we're in a very funny country, and I think I think the tribe guy attested to it last week. We're in a country where we are not the highest inflation. Let us know, even Ghana is doing like 30%, and I think Argentina is doing like maybe 50-something% inflation. And in reality, there's really no investment that is going to actually give you except like, so now beware of all those agri investments. Sometimes they give you the 200%, but with high risk, like I said, is high risk of defaulting, right? And I think because of the maybe say low risk and all of that, that's why like some alternative investments, which we will talk about eventually, that's Bitcoin, all of those things were created, right? Normal investments, nobody can really give you a 30%. No, 30% is good, is great, is high risk, but it's not what you do over the years. I think on a year to date, over 10 years or something on the US stock, I think the average is, I think it could be 20% or something, or not even up to 20%, right? So averagely, nobody can really give you like so much over the inflation rates. And that is unfortunate. It is rather unfortunate. And like now, Nigeria is printing at a 20-point-something%, right? And we investment managers are under pressure to customers clients keep asking us the question, like, how do you invest in the market? Like, imagine you. So remember that it's the relationship between borrower and saver. So imagine you as a borrower, somebody is saying that we, the savers, we are the investment managers, are saying that we want you to borrow at 20%. I don't know if you get it, like say a company, you want to borrow money and they're saying you should do 20% interest on your loan. That's too high for a company sometimes, for some companies, right? Like realistically speaking, you might not be able to pay 20% interest on your loans. And even for, say, Nigeria might not be able to give you 20% on your treasury bills because it's like a lot of money. But guess what? Like inflation is 20%, and so that 20% is even breaking even. No, it's not even that you're even getting over like a premium on the inflation value, right? So it's a dicey situation. I was speaking to somebody yesterday, and he said even he like is one of the traders in the company, and he's like, even he now, the next thing is to hold dollars in cash because everywhere is just very slippery. And at this moment, at this time, see, dollar is actually strengthening against every other currency. I think it's the most now. Even pound itself has fallen because every country is actually battling inflation. This inflation is touching everybody, even America, but their own inflation, and they are crying. Oh, they are just crying. It's 4.3 or thereabouts, right? When our own inflation is 20, we're swimming in inflation. They 4.3, all of them are just crying that inflation. But I understand that is very different for different people. But so like I said, it's just a battle we have to fight. I can't really say that this is. I might not invest in treasury bills, to be honest, because it's not giving so much interest. Like, why would I invest in treasury bills when I can do other investments, like I said earlier? And treasury bills is even in Naira. Then Naira is falling, then there's inflation. That's two bad things happening to it at the same time. So I'll rather probably do a dollar investment, right? That gives me like a 10% yearly than to do a treasury bills that will give me 9% of Naira. Because now dollar is the one that is the king, right? Because like, of course, there's inflation in the dollar, but you can't compare 20% inflation to 4.3% inflation. Hello.
Yeah, thank you. Talking about the dollar, okay, for dollar is trading at 720 or 725 at black market right now. Okay, let's say the person hedge the money, convert the money to dollar, but that doesn't still save the person from inflation, because right now, okay, for example, let's use 100,000 naira now. The person save 100,000 in dollar. Fine. Over time, when dollar depreciates, that means it has gained. He has able to hedge the money over the naira depreciation. But at the market value, looking at it, it won't be. Let's say, okay, you want to use 100,000 to buy. Let's say something of. You want to use some. You want to buy something in August for 100,000. Now, it still has that 100,000. But right now, let's say in November now, the thing that he wants to buy at 100,000 has now increased in value. So that means he's still losing money.
I don't get
but
that.
He's not losing money.
Come again.
Okay. For example, now someone has 100,000.
Okay.
So he has intention of buying a TV in November.
Okay.
So this money he has converted to dollar, so that naira depreciation won't affect it.
Okay.
But looking at it on the market side, what he wants to buy 100,000 in August has increased in price to 140. Let's say 140,000 naira now. So that means he's losing on the market side, but he's not really losing on the naira depreciation side. So what do you advise against such?
It's losing on the market side, but it's not losing on the. I'm still not really getting the question. So let me say what I get. Okay, so you want to buy a TV in August. So you have 100,000, right? Then you now invest it in a dollar investment, right?
Yeah.
Yeah.
So now you are buying it in November, but the price has increased.
The price has increased. Okay. You're saying that. So what was the dollar increase between say August and that November?
Okay, let's say the dollar increased by 30 naira.
Okay, that's how many percent? Let's do it in percentage. Okay, so don't let us overflog it. So what you are trying to say is that the person is still losing money.
Yes. Even though he's not losing money to the depreciation, he's losing money to the market side. Because what he would have
That's inflation
got at
now.
100.
That's inflation.
But how do you hedge against that? How do you make sure that
why
you
would
are
you
not
want
losing
money to so if I have 100,000 naira right now to buy a TV and the TV costs 100,000, why will you want to keep the money till November? So you need to understand that there's time value of money. If you don't buy what you want to buy now, your money, the worth of your money decreases with time. So immediately you collect a 10 naira, immediately you collect 100K right now, right? By tomorrow, whether Nigeria inflation or America inflation or anything, your money is already depreciating, right, over the years. So if you have 100,000 USD or 100,000 naira to buy a particular TV at a particular time T, just buy your TV in peace and not in pieces, right? And just have your TV. So like you hedged against anything that can happen. Remember that investment is a risk, whether it's treasury bills investment. I already explained at the beginning that what they are paying you on investment is the risks that you can lose your money, right? So anything can happen in investments, whether it is even fixed income or not fixed income, right? So the money you are saving is the money that you don't need. Like the money you are trying to move, like not that you don't need, but like you have excess, you're earning 200K and your earnings in a month is like 100K. So it's mainly 100K. What do you do? Instead of boiling up and down and just wasting all your money, you move the money into the future. So if you have 100K to buy a TV right now, just buy it. Instead of trying to save it and multiply it or double it, right? Because anything can happen. Like the market always moves, and the inflation happens every time. It's just that we don't want the inflation to be like 20%, like what is happening in Nigeria, right? Like I said, initially, US inflation is around 2% normally, but now it's already 4%, which is also high for them. And everybody is crying, and that's due to is a national, everything that is happening now is actually a global phenomenon. So the NASDAQ, let me even see, I think I wrote it here, that how much they've lost, Abby, is down like over how many percent on a year to date. So everywhere is bloody, blood is flowing everywhere. So even in UK or everybody, all the old economics, except Nigerian economists, they are trying to they're trying to tighten, everybody's trying to manage money, everybody except us, right? And basically that's it, right? So there's a lot of uncertainty. Just buy whatever you want to buy instead of saving it. I don't know if that explains it. Adebayo, you have your hands up.
Yeah, hi, Bukunmi. Thanks so much for the knowledge share. It was very, very well appreciated. Can I quickly chip in something in respect of the last question? Then I can ask my question. Is that fine?
You said?
Can I quickly chip in something? Please, can you hear me?
Okay.
Yeah, in respect to what the person asked last, and then I can ask my own question.
Okay, that's fine.
Yeah, I think in my experience, yeah, if you are doing dollar-based investments, at least since a couple of while I've been using Rise, it's advised to just commit on the long term. Yeah. If you're not committing on the long term, don't do any dollar-based investment, because in between there'll be charges. Yeah. In either converting from Naira to dollar and even from dollar to Naira. And whatever you were saving it for, envisaging it for on the long term might be lost in between. And then if the person is willing to buy a TV, you can do buy now, pay later products, yeah, that can help at least in the short term. Yeah, please. Then my question, please. I think I have two. Since you mentioned equity investment, yeah, I wanted to know if you likely have any opinion on any thought around equity investment clubs, such as maybe HOAQ. Let me not pronounce rubbish their name now.
Yeah.
Or similar clubs like that, yeah. And like what the returns look like, yeah. What thoughts do you have on them, is essentially? And then also, you said you do shares in like Nigerian companies, Guinness and Co. Is there and then in between you mentioned the fact that you're also hedging against inflation in dollar-based investments too. Is there any reason you are still abiding by, legacy companies in Nigeria, you understand, such as Guinness and Nigerian breweries or and MTN too. And then in particular too, you said you most likely invest in Guinness than Nigerian breweries. What are the particular reasons like? Yeah.
Okay. So I'll take from the first oak. I don't think I really know what oak is giving, but I think what you're trying to say is maybe like all this investment club, like what's the one that Bolu came to talk to us about. I think I have an idea of what they are doing. So I think it's very fantastic, right? So what they are doing basically is mostly like, I'm not really sure, but from what I see that they put up, is mostly like angel investment. So they pull money together and they invest like on a large scale. It's more like funds, right? They invest in, say, I think they do private equity, private investments. They also give loans. If you know more about like their investment, maybe you can shed more light. But what it looks to me like is that they bring, just like Bookhub. Somebody was suggesting that we had a Bookhub investment club, so I can just like everybody put money together, then we find investments that are really good, and put them in and collect like returns on it. And I think it's not bad. It's more like you're disrupting a company like as a cardinal stone, right? It's more like the basics are the same all over, right? You're just doing it in a different way. You're making yours community driven and fun, right? So because some of these ticket sizes, like investment, to be honest, pays mostly rich people. Right? But it doesn't mean that you can't become, and that's why I always say every time, the only person you can bet on is yourself. Market is going to shame you. And when you are thinking that you are going bull, beer can come. So the only person you can, and we already said that earlier, that make sure that you always make sure that you increase your capacity for investments, for earnings, increase your earnings capacity, right? So for those kind of things, I think they are good. I don't really know the structure of their this thing. It just depends. You just need to like find out more. What are the people that are making your investment decisions for you? Some of these guys actually invest with us, really. They take money from all of this club. When we have like a private placement, say MTN is raising 2 billion naira, and we need large, and some of these, like I said, the ticket sizes are large, like say 25 million, no, basically 5 million actually. And maybe one person can put 5 million. Like if MTN is, for example, raising like like I think they just recently raised the commercial paper, and you don't have up to 5 million to invest. What I can do is I can tell everybody in Bookhub to contribute money. Then we put it in, and everybody gets like interest at the end of the day, which is fair. And of course, they get commission because, like you were saying about charges, everybody actually charges everybody. Because how do you think Cardinal Stone makes money if we don't like charge you? How do you think RiseVest will make money if they don't charge you? So what I do with RiseVest, so just piggyback on what you said, is sometimes what they do is that after a particular amount of time, like if you do a 6 months, for example, you don't take your money in that 6 months. Right. So at the end of 6 months, they're not going to overcharge you. But of course, there's always charges. There's always hidden charges. Everybody's going to, if you are even doing trading, anything, you collect money. You'll collect money for helping you to invest. Yeah, so that is that. I'm not really sure. You can just try to understand, like I said, understand people that are making the investment decisions in whatever club you are. Make sure they are tested people. They have like they're trustworthy, because these days like Nigerians are really getting into the hands of, and it's really hurting. People get into the hands of all of these guys that really collect money from people and they run away, right? So then sorry, I can't remember the second question. I was trying to write it down. Okay, you said, why am I still investing in Nigerian stocks? Because and considering the fact that there's inflation and all of that. Like I said, so what I do basically is try to diversify my investments, really. And like I said earlier, January to June, Nigeria experienced a bull run. And if I give an example that if you invested in say, I think there was an article I read, and some companies actually did a 100% return, for example, on their stock, on the price of their stock. You can't get that. You might not be able to get that, say, for example, in an Apple investment, for example, because 100% account for inflation, account for devaluation, you will still have like a lot of money extra. Some people, I remember when I got into Cardinal Stone, I was speaking to one of the traders. It's like he went into dollar investments, but he got burnt because he did not understand how the dollar, the market actually works. So he had to come back to his Naira investment, and yeah, he was able to make a lot of money. Right, you are thinking that Naira inflation, this, some people are really making money. It just depends on how you understand like the investment. And like I said, what I do basically is just diversifying. Whether you like it or not, we still spend Naira in Nigeria, right? So it's just a way of like when I opened up my stock account, I was just basically, like I said, I'm young and I can always make the money back. So it's just like taking a risk, trying to see how the markets work, trying to bet on companies that I think would actually make more sense. And in equities investment, sometimes equities investment, it's like you're buying into the company. Sometimes you buy because, that's why when somebody is preaching about the company, they sell the spirit of the company. I tap into, I like this idea, very vision kini company. I love what they're doing with this company and I want to be a part of it. So you buy the shares of the company. So there's also that, right? Doesn't mean that right now I have stock in Bamboo. Since January I've not even opened it, because I open it, I can't even cry, because like I said, that's why I said I try to diversify my investments. And you understand what is happening part time. You understand why the US market is red. Maybe we might not be able to go. There's a lot of macroeconomic explanation. I explained earlier that before you invest in a company, number one, you're looking into the fundamentals of the company. Fundamentals, you're looking at the management, you're looking at the business model. How do they make their money? Because the business model is how they are going to pay you back, right? You're looking at the fundamentals of the company. Then you're looking at like the macroeconomic realities, and which is what is affecting most of the companies in the US. There's a macroeconomic play, inflation rates. They are increasing interest rates. The Fed just increased they released another report last week. This week. We're still on this Saturday, and they increased the interest rate. So the interest rate and the equities market, they have what's the word, inverse relationship. Once we sense that once the market sense that the Fed wants to increase the interest rates, or they increase the interest rate, money flows from equities and it flows into fixed income. I hope I didn't lose anybody there, but basically that's why it looks like the equities market is down. Also, there's also supply chain issues. There's the Ukraine, Russia, whatever. Energy is on the rise. So those are the things that are affecting the US stock markets now. And like I said, we still envisage that the Feds would raise more rates this year, maybe two more times. So maybe the stock will still go deeper. So maybe this is not, like I said, this might be a good time to buy. It might not be a good time to buy. You need to just always watch out for stuff like this, like when the Fed is increasing rates and all of that. So that's what I'm saying. Like I basically diversify. So why did I choose MB? Why did I think Guinness is stronger than MB? So it still ties to what I said earlier. When you read about the company, you read about, so now because of the what they call it now, the macroeconomic realities. Okay, so for example, Dangsem and Bois Cement, I think there was this report that, because now cost of producing goods is very high. Some companies have already they have like alternate way of sourcing their costs, right? So that means if like there's company A and there's company B, everybody, generally, inflation is there. The cost of production, and I know everybody understands what cost of production is high. So, but company A has a way of getting alternate source. They have, like, say, I don't know, maybe I think for company A, let's say energy, because energy is high. Maybe they've moved into solar, so they've cut the effect of high energy costs that comes from petroleum and all of that has already been taken away from their books. And that means it doesn't affect their profit, their income at the end of the year. So if I think about it in that way, I'm going to invest more in company A than in company B. I don't know if you get Bayo. Is he on the call?
Yes, he is.
Yeah, Bayo, do you get what I'm saying? Yeah, so that's
I do definitely.
Yeah, so that's one of the things that you think about. And say, for example, why will I invest in let me talk about the banks. which one is that very funny bank? Anyway, basically they are big banks, Zenith Bank, all of those guys, over a Wema Bank. But I think Wema Bank is good, Sha. This is my own, but I'll not invest my clients' money in Wema Bank. It looks like they have their head on their necks. And I'm thinking that I've not invested, I don't have any money there. I not say that I should invest in Wema Bank, but it looks like they're trying to position themselves. They've been trying. I see that their small cash is really shaking, but like, I'm just saying, like, largely, like, I want to do a Zenith Bank because of the proof. Like, say, okay, now for analyzing banks is actually harder if you're not a finance person, and because now there's high rates, high interbank rates, or all of that. So some banks have a way of hedging. That's why some of these banks, yes, old core structure. You hear that Access Bank has gone old core, so they've moved from their core credit business to incorporating other businesses, like they're trying to expand. So the way they make their money is not through credits, through banks anymore. So now they have an old core or a old core structure. So that means that they are thinking of many other ways to make money. So what am I doing? I would try to like buy, because it looks like on the outlook on the company means that there'll be more money in the future, right? And there will be more dividends or something like that. Do you get it? So those are some of the things you look out for when you're trying to choose the company. Do you know what I mean? I think we've spent a lot of time. I did say one thing before I see your hands up, but before I finish, there are two ways to make money on an equities investment. One is price increase and two is dividend. So those are like the two ways, because you can't get your capital back in that sense. It's not like a loan investment that you get your capital back rather. So the way you're getting your you're getting your, which is, I'm just trying to put all of the things I've been saying. Two ways: increase, price increase. Let me see how I even wrote it in this place here. Hold on, please. I'm going to release everybody. Capital appreciation and dividend income. If you don't get anything from it, capital appreciation, that means if the stock is trading at 19, you're betting that if you come in at 19, you're betting that the stock is going to maybe increase to say a 31%. They call it, by the time you do a 31 minus 19 over 19 times 100, which is what we did with Airtel. But guess what? If you buy at 19, what's the assurance that it's not going to dip to 10? So that's why it's high risk. So the other part is dividends. If you don't know, companies pay dividends, but the dividends that they pay, so now let me just talk briefly about dividends. It's actually dependent on what the board actually agrees on. So the last Airtel, MTN paid a 5.6 naira per share dividend last interim dividend. So if you have, depending on the number of shares you have in MTN, 5.6 times that, so that's you making your money from, that's the other way you make your money from MTN. But remember that not all companies pay dividends, because they are not contractually obliged to pay you any dividends. And that's why that's the risk of stock investments. So sometimes I was following some guys on Twitter. They are like dividend investors or something like that. So they look for only companies that pay dividends. If you don't pay dividends, you're not investing in your company, right? So maybe if you're looking out for stocks, so you probably want to look out for companies that pay dividends. Traditionally in Nigeria, I can speak to Access Bank, Zenith Bank, Fidelity, all these guys, they pay dividends. Most of the banks, Access, UBA, they pay dividends. MTN pays, fantastic. Me, I like MTN, Sha. I don't even use them. I don't even use their this thing, but I like them. They are like one of the Nigerian equities companies. There are not so many, really, to be honest, and they are very scoring. Most of Nigeria, we don't have like great ethics and all that, but MTN is one company you can vouch for, right? So MTN actually pays dividend. Well, some of these stocks, they don't pay dividends. So any stock that doesn't pay dividend, what you are betting on is the price increase of the stock. Right, so I just wanted to put that in. Samu, please, you can unmute.
Okay. The other time you were talking about mutual funds.
I was talking about what?
Mutual funds.
Okay.
But you said it gives 8%.
Your network is bad though.
Hi, Sam. Okay, yeah, I was about to say that.
Can you hear me now?
Yeah, I can hear you.
Yes, we can.
Yes, so the other time you were talking percent. I wanted to.
Or will you just type it in the chat box?
No, let's
We'll just read it.
My God will bless you. My God will bless you. Chat box.
Okay, are you typing it in chat box?
Yes.
Okay, because I can't hear you, like it was going off and on. Okay, so does anybody have any other question? I don't think there's any other thing I want to cover, but I think there was a question Olisa asked and he has dropped off the call. I said, so private equity and venture are types of private placement. I think, yes, that's the answer to the question. That you can, like, those ones are like private placement transactions. Yeah, you just find some company and you put it in. I wanted to say that, yeah, somebody said nairametrics. I don't know why they said nairametrics, but you can subscribe to, because you need to know what your money is doing. You cannot just buy stocks and just leave it there and just be going like that. So try to read research works, read nairametrics. Like, so I feel like knowing how to understanding investment is it could be very simple, right? And just really knowing what your company is doing, because if you invest in remember that if you invest in your friend's company, you always want to know what, if you hear that the bike, say a logistic company, and bike our accident, you start thinking of what your money is doing there. So that's like just the way when you do like public this thing, you want to know what is happening in the company and what your money is doing there. Also, before I forget, what else? I think I've kind of spoken. We'll talk about the remaining ones next year. Oh yeah, 8% is yearly. Sorry, 8% is yearly. It's not monthly. So another thing is that fixed income investments, like per annum, you are sending direct message to me, or where is not to everybody. So you can just try to make it to everybody. So yeah, okay. So that's per annum. So I feel like Nigerians were very spoiled. We're used to 60% per annum, or no, 200% per annum investment. And that's why people have been taking your money and taking it to the Bahamas and running away. Be careful of investments that actually give you 200%, 150%. Even if it's entering 60%, you need to be careful too. Right, so the only maybe sources of money that can give you 60, 100% would be real estate, which we'll talk about, Ponzi, real estate, all of those guys, right? And even stock can give you 100%. I already explained, but remember that with high risk come high reward. Always remember that. When somebody gives you a 100% investment, remember that you're getting into it at high risk. And most you should not put your money, you're young. If you lose your money, you make it back, right? But remember that with high risk comes high reward, right? So generally, equities, as in, what's your take on pyramid? We'll talk about that later. My take on pyramid scheme investment, of course, I feel like it's calm now. It's calm. You need to understand how money is being made, which is what I actually explained from the beginning. Financial systems, right? Always remember that money is flowing from excess to people that don't have. So you need to understand, it's not a pyramid scheme is you're robbing Peter to pay Paul kind of thing. And your money is not, you're not using your money for anything. You're using it to just like, I don't even know, they're just collecting money from this person and giving it to this person. What you're supposed to do in an investment is a borrower is supposed to collect money to do something, to embark on a project, to do like something that's going to give them returns. Out of that returns is now what you now give your lender. Yeah, so I think we have come to the end of equities investment. Is there any other question that anybody has? Like I said, I wanted it to be practical. I hope I was able to like do justice to explaining this. We'll do fixed income investments next week.
Thank you so much, Bukunmi. Thank you so much, Bukunmi. Ehis hand is up. So I think the last question we're taking is from Ehis. We have a question from the community. So we'll just round up with that. Thank you so much, Bukunmi. It was very insightful.
You're welcome.
And yeah, I think RiseVerse should just sign you up as an ambassador.
Okay, well, yeah, I'm comfortable with RiseVerse. The disclaimer, you can always do your own research. You can do Trove, all those guys, but I'm just really comfortable with RiseVerse. I like their UX. So there's also like personal, I don't have any stake in RiseVerse. To me, I just like this thing. And you know, when I went in, I think Naira was dollar was like how much was it? Like maybe it was around maybe 500 or something then when I went in. And when I was liquidating my investment, maybe like something like somebody said that you invest in dollar for long term. It was not really long term. It was just, I think I did a 6 months because I wanted to test them. And at the time I was liquidating, it was like 700. So imagine that, like, I've made like some money more, and like my Naira equivalent is more, and I also got like percentage. This thing is not a lot of percent, but like I understand what I'm doing, sure. That's what I'm saying. Then always remember, we'll talk about that compound interest, which is very important. Reinvesting your money. Always remember, like, it always works. Compound interest is a very wonderful, especially if you are building wealth, right? It's for people that are building wealth. You're trying to build wealth, so you're projecting. And also remember that the last thing, I wanted to say was that don't do equity investment for your parents. Like, so in Cardinal, so we have like, we divide our investors into 3 risk buckets: aggressive, balanced, and conservative. Aggressive is mostly, if you see aggressive, those ones are very aggressive, bullish. The 70% is in equities, while 30% is in fixed income. I recommend to you guys, so you people, because you people are small children, young people. I don't do aggressive, by the way. Yeah, young people, if you lose your money, you can make it back. That's what I tell my friends. If they say, should I invest in something? If you lose your money, you make it back. You're young. You just cry for a few, like 2-3 minutes. It is, you make your money back. All the money you've lost, you make it back. So 70% in equities and 30% in fixed income. That's a way for you to maybe divide your money. Balance, which is what I am. I do 50% equities, 50% fixed income. So I'm just always in the middle, right? Then conservative is what I would advise for if you are young too and you don't like stress, you don't want anything to touch your money. You can do 70% in fixed income and 30% in equities. I will repeat, aggressive, 70% equities, 30% fixed income. And that equities could mean maybe, it could be any risky investment, basically. Then 30% fixed income. You like, fixed income means, which we will talk about next week, which is like your money is coming back, nothing is happening, you're collecting it with interest, no story. Balanced, 50% fixed income, 50% equities. I handle balanced portfolio, by the way, in Cardinal Stone. Then conservative, 70% fixed income, 30% equities. Yes, please, is your question. Hello.
Hi,
Sorry.
Real estate is alternative. But please go on.
Thank you, Books, for this amazing session. I've learned quite a lot. I think the most important thing I've gotten today is to always, like you said, believe in the company you want to invest in, right? When you believe in them, then you're able to stay for a long time, and then you get the benefits of compound interest. So thank you so much for this amazing session. So I want to ask a question. I think it came up last week, but I didn't get, I forgot to ask it, right? So me, I don't like to lie. I like to get my money when I put my money, right? And so I've been thinking about, what's your thoughts about local investment? When I say local investment, okay, you have some money, you buy Corolla, and then you give somebody to start driving for you, and every month the person pays like money on it. I don't know. Those kind of investments sound interesting.
That's not an investment.
Right? Huh?
It's an investment, but it's not exactly an investment. That's a business.
Okay.
So
Yes, those kind of businesses.
Yeah, so that's you starting a business. It's not exactly an investment. I don't think it is, right? It's also, that's you starting a business, right? Because I know that we're lazy people. You just want to give somebody Corolla, the person just be driving and you just be collecting money like that. What if you drive your money, the car into the ditch, or just run away with your money?
You do lawyer this to
that. But you know that's also equity investment. You can also call it an equity investment. Either you call it an equity investment or you starting a business. You just want to be doing, that's a way. But remember that it's high risk, high reward. Nigeria, that you don't trust people. I remember my daddy bought boss for somebody. When the person brought a picture of burnt boss, say boss have born. The person or the boss didn't see it. So you need to understand that it's also I think it's a form of equity investment, right? But it's all, you can call it equity investment, but it's also a form of, it's a business really. And when you're doing business, it's also like an investment, it's a business. So while you're doing that, like I said, you can do whatever. Just make sure you say diversify, right? Don't put all your eggs in one basket, right? You can, diversification is like mostly key. So we can talk about diversification at the end of the session. So we just really talk about plans, how you can like, and I already gave you an idea of how I diversify my risk, right? So you can do that, it's fine. Like I said, you are young. If the guy drives your Corolla into the ditch, you would make the money. You cry for like 1 or 2 minutes.
No, me, I'll cry for 2 weeks. So 2 weeks straight.
2 weeks is still okay. You shall stop crying one day and you move on. Compared to somebody that is older, that is maybe 70 and is nearing pension years, and you now go and give somebody Corolla with your pension money, and the person, you can't make the money back. So that's why when it comes to investment, you need to understand that context is different. When I'm like, somebody going to go and tell my mommy that they should be doing Forex, I said, don't put your money in Forex. So I know that it's very easy to prey on all those older people. Say, am I going 10, 100%, skinning 100%. Don't put your money in Forex. That's all I just told her, don't put your money in Forex. You don't need Forex. You don't even need to start putting your money in risky investment because you're already nearing retirement age. You can't really make the money if the money goes bust. But like I said, you're young, you cry 2 weeks and you stop crying and you make your money back. So yeah, that's what I'm going to say about it. So just think about it as, yeah, you're actually handling a real business. If you give somebody your Corolla, you need the person to be accountable to you. Just think about it like it's a business, right? Because people make businesses out of it. That's what say someone like what's the name of this? A Move. That's what they are doing. They made it into a business. Buy cars, give people, let them drive, give me money back, kind of thing. That's a business, right? Or you could think about it as an equity investment, and it comes with risk. So either ways, just know that it's high risk.
Don't worry, I'm young and I'll make my money back. That's the thing I've learned.
Yeah,
okay,
you're young, you make your money back. No,
okay,
just if you cry for 2 weeks, make sure you stop crying and make your money back. So
thank you, Bukunmi. Our last question.
Let's talk about real estate. Real estate can be fixed. So they classify real estate mostly as an alternate investment, right? There's something called alternative. All those ones, you're not under fixed or equity. But you can also think of real estate as being fixed because depending on what you do with your real estate, right? If you lease your house out to somebody, the person gives you like a fixed, but you can't even really say it's fixed because you don't get your principal at the end. You just keep getting money into perpetuity. So we'll examine that later. That's also a way of making money, and I think it returns higher than even all of this, but it's only for big people. You can't buy land in, some people that bought land in Mowe that time till today, they've not still gotten the return on their investments. So it just really depends. Like imagine if you have a lot of money, you can buy land in Eyebrow, not really high, but like you come to Surulere, you see 1 or 200 million kini, you can buy and you get your money back, right? So this fixed real estate is actually a way of making more money. But if you have bigger, deeper pocket side, that's when it makes more sense.
Okay, thank you so much, Bukunmi. So the last question.
You make your money back. Yeah. last question, sorry.
The last question is that what investment opportunities would you advise for students?
Students won't be investing safe. Just drop your money. Mostly invest in yourself. That's what I think for students. Mostly invest in yourself. Like depending on your income, if you are getting 20,000, what do you want to use 20,000 for? Okay, maybe you can do mutual funds, You can also buy stock as a student. Is a way to it's a way to actually learn. If you want to learn about investments, you can just buy 1 or 2 stocks. They are like Fidelity Bank is 3.3. I think at some point it was 3.15. Now it's like 3.47. If you buy like how many, like use 10,000 naira to buy Fidelity 3.17, you get like a lot of Fidelity. And if you sell it, you will get more money back. If you sell it now, because now it's really trading higher, you get your money back. So you can do one or two. You can actually do one or two, depends on where you are. All of this is still the same principle. Just understand your why. As a student, why do you want to invest? Like, do you want to like learn more about investing? You want to build your wealth, but you can't say you're investing 20K and you want to be $30 next 2 years. It's not possible. Sorry, your 20K can't do anything, basically. So yeah, so I think everything I said still applies. Just find your why, learn, lose money, gain money back, learn from your mistakes. Don't let your greed blind you. I think that's all.
Okay, someone also said, what can you say about the piggyvest real estate investment?
I don't know the piggyvest. So maybe we can do an analysis of all of this. If you have like some questions with regards a particular kind of investment, I don't know the piggyvest real estate investment. I have piggyvest account. I don't know. Oh, they were asking me for one thing, and it was so stressful. So I don't use piggyvest. I think I use Cowrywise. Cowrywise is also where I just dump money and I don't really need. One time I did not have money, I just went to go and liquidate all the money in Cowrywise. So that's why it's good to save. Like sometimes I don't just have money. I just remember that there's no money there. Please give my money. I just liquidate it around like that and start again. I know that all this my 20s kobo cannot make me Dangote. So I'm not expecting to be Dangote from there. I keep saying. So what I do mostly is that I just invest, like I say, or I would say I invest in myself. Yes, I have to invest in myself because I want to increase my earning power. Investing in yourself is also starting a business. That's like Naval will say, make sure you own a part of something. That's the way you can actually be rich. Doing all this $5 investment that we're doing might not really make you rich. However, there's also the law of compound investing, and it actually requires patient capital. You have to wait it out. There's a guy in our firm that actually has like big, you see his children himself, they have funds already. He buys like 1 billion worth of it. Like that's what we're talking about. Maybe I'll talk about Euro bonds eventually. Euro bonds, if you don't have 200,000 USD, you can't invest in the Euro bond market. Me and my colleagues used to laugh. Some people who have like 150 or even 90K, they say they want to invest in Euro bond. Euro bond for big people. Go and make your money. Let your money be complete before you come and start telling us anything. If you don't have 200K, we're not listening to you. So if you have 200 USD, that's how you can invest. And with Euro bonds, you can even get a 20% investment, 30% return. Now Ghana is like 40%, but it's high risk return. Ghana can default and money can go bust. But like I'm just saying, you can even get 50% return on investment. You see people putting in 900K USD. So let your money be complete. When I say invest in yourself, I know what I'm saying. Invest in yourself, start a business, like get more money, make sure you increase your earning power, such that even if everything goes bust, you can still come back and you can still get your money back. So that's it.
Thank you so much, Bukunmi. Thank you so much. This was very insightful. I really look forward to next week's class, and we have some questions already for next week's class. Thank you so much for taking this up, Bukunmi. Thank you for blessing us.
If you have any particular type of investment you want us to analyze, kindly send it to me before the next class so I can just really research into what they are offering and would analyze it together. I hope I'm able to make slides before next week. I'm sorry that my slides were like kwashiorkor.
Thank you so much. Thank you everyone for joining. Thank you so much. If you'd like to unmute your mic, say something nice to Bukunmi. Thank you so much, Bukunmi. Thank you so much. I had a great time, and I'm sure others did also. Please unmute your mic and tell Bukunmi thank you. Thank you so much.
Thank you.
This session is like 100K for Money Africa. Thank you, Bukunmi. Thank you so much. So I think we'll just call it.
Thanks for having me. Bye.
Next week. Thank you everyone for joining. See you next week. I'll share the updates with you. Thank you so much.